Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing a stock that was brought to my attention by none other than of course Vivek, where he says, can you do CTSH please? I want to know your thoughts on it. And well, doing a little bit of research, very basic research on this company, because I'll be honest, I didn't even know what this company even did. They're essentially a consultant technology company, right? That's about as much as I got when it came to the research status. I want to actually do this as blind as possible, so that way you guys can actually see how I usually do my process when analyzing a company, even though I may not even know it. So with that said, let's get started with this video. Starting off, guys, we got the dividend summary. This company does pay a dividend of 1.24%, which actually ends up being around 27 cents a share for an annual payout of $1.08. Now, they do not have a payout ratio, and they do not have a 5-year growth rate. Normally, this would be a huge red flag, but upon doing further research, we find that they actually started paying this dividend as of May 17, 2017. So knowing this, it is impossible for them to have a 5-year growth rate if they haven't even reached their 5-year mark yet. And when it comes to their payout ratio, well, this payout ratio doesn't really mean anything, at least to me, because this payout ratio is in regards to the net income. I like to take a look at the payout ratio in regards to the free cash flow, which we are going to do once we get into the spreadsheet. But nonetheless, they have grown this dividend for 2 consecutive years, which is not that bad, honestly. And, well, their ex-dividend date is coming up in about 2 days. So, if you want to get in this company, assuming that all their metrics look okay, you have about 2 days to do so. They're going to pay out this exact same month on the 28th, and they pay their dividends quarterly. Now, coming over here to the spreadsheet, we got the ticker symbol, as I said before, CTSH, market cap of around $45.3 billion, which isn't too high, but it's not too small. I think these guys are like a mid-cap kind of company. PE of 21.31, so it's a little bit high, but we're really close to that 20 marker. Does this mean that we don't buy just because it's a little bit overpriced? According to the PE, not necessarily. We're going to take a look at other metrics and then come up with a price that we should be paying for this company, making certain assumptions based on their growth and their share buybacks. Current share price, guys, is $86.24, and as we saw, they do pay an annual dividend of around $1.08, which only ends up being around $567 million being paid out in dividends every single year. And in comparison to the free cash flow, their 5-year average free cash flow, they're still left with, after this dividend is paid, they're still left with a whopping $1.7 billion, which is really good. In fact, this is so good that this only comes out to be 24.5% in their payout ratio in regards to the free cash flow, which is really good. This is honestly like one of the best types of metrics when it comes to dividend affordability that I've seen in a company, because this tells me that not only are they able to afford their dividend, number one, number two, they are 100% able to keep increasing this dividend into the future. Next, let's take a look at their fundamentals, starting with the net income 5 years ago of $1.5 billion to 1 year ago of $2.1 billion. Guys, that's a huge increase of 42%. Now, when it comes to seeing this, 42% in regards to 5 years ago to 1 year ago. Looking at this graph when it comes to their net income is slightly increasing going up. Even though it is an increase, this isn't bad. I'm not saying that this is bad. I'm just saying that I would prefer it if they were to have a little bit more increase in their net income, but nonetheless, it's still very good. I'm not saying it's not, but I'm just saying I would prefer it to be consistently, steadily going up. Next, we got the free cash flow 5 years ago of $2.1 billion to 1 year ago of $2.2 billion, which is a small increase around 4% with an average 5-year free cash flow of $2.3 billion. Now, obviously, this is not what you want to see when it comes to the free cash flow. The trend line is increasing. However, the trend line is increasing because of this 2-year ago mark where it was $2.9 billion. So there's a couple things here as to why this was like this. And the one thing I could think about is just COVID. They are a tech consulting company. What do we know about what happened in 2020? A lot of tech companies got into the scene. A lot of tech companies needed consulting. So this explains why 2 years ago, they just skyrocketed when it came to the free cash flow. Whereas 1 year ago, they slightly went down. So when it comes to their free cash flow, it really does depend on, I believe, what is the demand for tech at that time period. Explains why 2 years ago, when tech was really in high demand, everybody was using Zoom. A lot of companies were, working from home for an entire year, right? In my personal experience, I worked from home for an entire, actually more than an entire year at my engineering company that I used to work at. Think about that. So if that was just an engineering company, I was working from home. Think about all the other companies that were forced to change the way that they do business. Next, we got the revenue. 5 years ago of $14.8 billion to 1 year ago of $18.5 billion, which is a pretty good increase, guys, of almost 25%, which is really, really good. And honestly, this is a really steadily looking graph. They did have, again, off year 2 years ago, but nonetheless, it is steadily going up within the 5, 4, 3 years ago mark and even into the 1 year ago mark. So pretty good revenue in my opinion. Next, we got the total assets minus the total liabilities. Essentially, this tells you whether or not the company is able to afford their debt. And obviously, you want this number to be positive. If it's negative, then that means that they can't afford their debt. They have more liabilities than assets. Well, currently, this company, if they were to liquidate all of their assets and pay off all their liabilities, they will still be left with around $3.8 billion in assets minus the liabilities. Now, positive number, we like this. However, something that's really, really worrying me here is that from 5 years ago to today, their assets minus liabilities is decreasing. So this could be one of two things. Either their assets remain the same and their liabilities increased, or their liabilities remain the same or roughly the same and their assets are decreasing. Definitely something to take a look further into. And currently, as it stands, it's not that bad because they are still able to cover all their liabilities. However, if this number continues to go down into the future, that is a huge, huge red flag. You do not want a company that isn't able to pay off their debt, because if the economy goes really, really bad, they're one of the first ones that are probably going to go bankrupt. Their average total assets is around 7.8 billion. Their average total liabilities is around 3.2 billion, and doing the average assets minus the average liabilities is around 4.6 billion dollars. Next, we got the shares outstanding. This one metric, guys, is the silent killer. This is the one metric that people don't understand. I didn't understand when I first heard about this. And this is the one metric that people tend to overlook. You want this to be going down. The more shares that they buy back, the more piece of the pie you get as the investor. And honestly, this company is doing really, really good. 5 years ago of 588 million shares to today of 525 million shares, which is a decrease on the 5 year at a whopping 10 and almost 0.75%, which is awesome to think about. 10%, almost 11%, they are buying back shares from 5 years ago to today. And not only that, on the year to year, so obviously the current year and the previous year are the same number. I'm going to take a look at the 1 year ago to the 2 year ago, and they have bought back around 1% from that time difference, which is again is really, really good to see. And lastly, we got the cash equivalents, and currently they have around $1.8 billion in cash equivalents, with an average cash equivalents are around $2 billion. Now let's make some assumptions, guys. I'm going to make a low, median, and high assumption. And for all of them, I'm going to keep the required rate of return the same at around 10% to match the S&P 500. And I'm going to change the growth and the projected share buyback. Now, where am I getting this growth assumption from? Well, taking a look at Seeking Alpha, we can actually see that the revenue growth year over year is around 11.14%. And the revenue growth forward, so this is what the analysts predict, is around 9.77%. So my job as the investor is to be conservative, because the more conservative I am, the more returns I will get if these target share prices meet. And for the low assumptions, guys, I'm going to assume 2%. Predicted share buyback, I'm going to assume 1%, which is what they did 2 years ago to 1 year ago. And in doing so, for the low assumption, we get a target share price around $71.01. For the median assumption, I'm going to say a growth around 5%, projected share buyback around 2%, and we get a target share price, not adjusting for debt, of $81.30. And lastly, from a high assumption, I'm going to say a growth of around 8%, with a projected share buyback of 3%, and this comes out to be, guys, $92.89. Adjusting for debt, however, For the low assumption, this actually comes up. So this is telling me that they have a lot more cash on hand than they do debt, which is really, really good. So for the low assumption, this number actually comes up to $74.53. For the median assumption, this comes up to $84.92. And for the high assumption, we get $96.63. Now adding a margin of safety of 5, 10, and 15%. For the low assumption, we would like to buy between $63 and $70. For the median assumption, between $72 and $80. And for the high assumption, between $82 and $91. Guys, the current share price is $86.24. Honestly, if you believe my assumptions of 5% growth with a 2% projected share buyback, we are right there. Like, we are almost right there to this target share price. If you believe my assumptions, me personally, this is looking really, really good. In fact, even if you believe my high assumption, we are essentially golden right here, right? We're below the target share price. So if you believe that this company will grow at 8% and buying back shares at 3% within the next 3 to 4 years, well, then you are essentially sitting pretty on this kind of company. You will essentially make a 10% return on this type of company. In fact, actually, you will make more than that because, well, looking at the margin of safety of 10%, we're still below with this margin of safety in place as well. Therefore, if you believe my high assumptions, then by all means, this is an absolute buy. But then again, if you believe my assumptions, if you do not agree with my assumptions, you can get this calculator. I have it for free. Anybody can have it. It's in my discounted free cash flow calculator video. All I ask for in return, guys, is like, comment, subscribe, share, tell your friends, right? Hit the bell. I want to grow my channel. We're almost there. We're 356, 57 subs. Awesome. I love it. Absolutely love it. We'd love to get to 500 by the end of March, so that way I can actually start making community posts, because right now I can't make community posts. So that's all I ask for, guys. So again, I'm not really telling you what to buy. I don't do that. I'm just showing you my assumptions and the raw numbers. All in all, when it comes to this company, honestly, I'm not saying that this is bad. This is actually a really, really solid company. I don't know much about it. Aside from that, their numbers aren't that bad, guys. And also, here's something that I did not take into account a couple minutes ago. And that is that because of the whole pandemic thing, companies have restructured their environment to work from home now. Most companies are from work from home. Therefore, if this is a consulting tech company, you are going to need a lot more of these guys into the future if more companies continue to adopt this, because people have completely switched from going to work to working from home. So if more companies adopt this because there's demand for it, well, companies like this will definitely be on top of the game. So I see a lot of positives here. And honestly, I'm half tempted to put some money in this once I go further into this, reading their 8K and their 10K for myself, and then going on to make my further assumptions on this. But that pretty much does it for this episode. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You can follow me on my new success of BitChute, Odyssey, and Rumble. Where in addition to my stock analysis videos and crypto videos, you will find exclusives as well. And when it comes to Rumble and YouTube, I have a Let's Play channel where I'm currently playing through Pokemon Legends Arceus. So if you want to catch that, please click the link in the description below. So with that said, peace out, and be on the lookout for the next stock analysis videos, because I'm going to be doing a couple of them that their earnings are coming up this week. So be on the lookout for that. Peace out, everybody.